The gold in the prior bull markets, it's eightfold moves, no big deal. Back and look historically, 10-year swings here and there, eightfold from 2000 to 2011, $250 to 1920. Even from the 1976 correction low at $103, you went to $850 by 1980. Historically, it's always been gold. This time it's going to be gold again. So to see gold make another eightfold move would be, so what? This time the crisis is going to be even worse. There's a lot of guys out there who are fundamental analysts of gold that I have respect for. They may not be good at timing, but they're good at their macro views. They're talking $20,000 gold situation. Wouldn't shock me. I think it'll go off the page. The key is to break the bubble that is pending in the U.S. stock market. When that occurs, all the dynamics shift, and gold won't go 2 steps up, 1 step back anymore. $8,000 gold it's a norm.
Historically, gold has seen eightfold moves during bull markets, from $250 to $1,920, 2000 to 2011, and $113 to $850. 1976 to 1980. With the current market dynamics, an impending stock market bubble burst, central banks resorting to monetary excess, and artificially low rates, gold is poised to benefit again. An eightfold move from the $1,000 low would be typical, potentially pushing gold to $8,000 or beyond. Given the severity of the upcoming crisis, even $20,000 in gold wouldn't be shocking. Once the stock market breaks, gold's upward move will accelerate sharply. The ongoing bull market is expected to continue, with experts like Chris Gaffney, president of the world markets at EverBank, correctly predicted the price of gold could reach $3,000 per ounce. MichaelOliver, a highly respected market analyst and founder of Momentum Structural Analysis, MSA, highlights that, while a government debt crisis looms due to rising debt-to-GDP ratios, the bond market shows technical potential for a counter-trend rally. This means a rate drop and a move into Treasury bonds as money exits the stock market. If stocks fall even 2% from their highs, T-bonds are likely to surge, especially as they've already begun to recover from recent lows. Demand for bonds tends to fall, sending their prices lower and their yields higher when investors expect strong economic growth and the possibility of inflation. Gold miners, like GDX, have pulled back recently but remain in a broader uptrend. Since breaking key momentum levels around $31.50 in March, GDX surged to $44 before retreating to $36, still well above its entry point. MichaelOliver is concerned that while miners often lag or lead gold in the short term, they ultimately follow gold's direction. Pullbacks are typical, with current price action above the prior multi-year trading range, indicating support. Historically, these moves can frustrate investors with their 2 steps up, 1 step back nature, before accelerating sharply late in the trend. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Technically speaking, if you're a bear in the bond market and expect, a government debt crisis to come because of, the government debt ratio to the GDP, the increase in government, it's all those numbers that we all know. Yes, that crisis is coming, and yes, it could lead to a disaster in the bond market. But from our technical point of view, we see a counter-trend rally potential in the T-bond market, meaning a drop in rates and a flush into the T-bonds. When the money moves out of the stock market, our bet is, you break the stock market 2% off its high, I'll bet T-bonds are starting to surge. Now, already bonds have tried to come up off the low of a month ago, and they've come up fitfully, sharply, and then pull back, and they're still fitful. But we think that there's a counter-trend sharp rally in T-bonds, but it is not a sustainable trend. It is a trading situation. So don't treat it like you would gold as a, quote, alternative that will last. Look back, 2015 low in gold was just above 1,000. It's now 2,700 zone. Okay. So you can do the geometry on that. Nice move. 2015 low in GDX, I think, was $15. We're trading 36 right now. Yeah, it's a pullback. We got to a 44 high recently. We got to a 45 high in the mid 2020 rally. So we basically went up and sort of double topped, quote unquote, at 2020 high. They sold it a point or so in front of that high. They said, let's sell it here, risk the difference. And you got to sell off because gold sold off. And the sell off spooks everybody. But if you just punch up a monthly, you don't have to do momentum. I'm arguing that long-term momentum on GDX, for example, or XAU index, which has greater history. You run quarterly momentum and draw a trend line. You don't have any structure nearby that is viable to break. You have a structure below that is likely support if you get there, which is not far below where we are right now once you get into next quarter, likely support. But they're not developed for a major downtrend. They're simply in a downturn within the context of a strong momentum upside, which is not mature enough yet. Yes, they're a laggard to gold and they're a leader to gold. There'll be times where the GDX for 2-3 weeks will beat the pants off gold and suddenly it'll get weaker than gold, percent-wise. That's when everybody pulls their hair out and says, it's no good, it's not going to follow gold. It will follow gold. That's the one principle you got to keep in mind. If gold is steady and up, forget GDX, it's going to flip up too. Flip up out of what may look like a nasty hole, but it's going to flip up. But even when you look at a monthly price chart of GDX, go back a couple of years and look at the action, we gave a re-entry point. It was like we did on gold coming up through 2000 in March. We did on silver 25 to 26 level back in March. We said, okay, if you're not in, get in now because we're going to have another surge. GDX then was 3150. And we urged, if you're not in them, this is a time to get in them. Well, they went from 3150 and now on this quote sell-off, we're at 36. Well, is it collapsing? No, it's still well above that entry point.
The Fed will shift focus to a weakening economy as the stock market peaks, pushing commodities into a new breakout. The Bloomberg Commodity Index, which doubled from late 2020 to early 2022 before correcting, has since moved sideways around 100, a historically cheap level compared to past highs. This sideways action signals a basing phase, and a breakout is likely just above current levels. Meanwhile, Wall Street analysts widely expect the U.S. Fed Chair Jerome Powell-led rate-setting panel to reduce the benchmark policy rate again after delivering its first rate cut since 2020 in September 2024. The new U.S. federal fund rate sits at 4.50% to 4.75% after the central bank slashed its benchmark rate by 25 basis points during the November policy verdict. Recently, gold and the stock market have moved inversely, with gold rallying when stocks pull back and vice versa. Weekly momentum indicators show this clear opposition. If the stock market breaks key trigger levels, especially heading into next year, gold is likely to rise sharply. Unlike its usual 2 steps up, 1 step back pattern, gold could move vertically as significant money flows shift into it, driven by a breakdown in the broader market. Now let's dive into the interview.
Preoccupied with the weakening economy, which will occur once the stock market peaks. We think that's basically inevitable and soon. The data points will change and the Fed will have to shift to economic mandate, unemployment, et cetera. And the big banks will be banging on their door saying, you better shift to that attribute, that mandate. That's going to be a key factor. But the notice what's happened to the Bloomberg Commodity Index. The Fed claims great victory over inflation. Well, in early 2022, at the start of the war in Ukraine, that was late February 2022, the commodity explosion, which began in late 2020, from our metrics. We said there'd be a commodity explosion. Well, the Bloomberg Commodity Index doubled from our entry level was 70 level. It went to 140 by March of 2022. When the war began, commodities started to correct sharply to the downside. Now, and they collapsed by early 2023, the Bloomberg basically had finished its correction. Now, I know the Fed likes to say, well, we brought the markets down. Well, actually, the commodity markets had peaked and come down seriously on their own based on a need to correct. They just doubled in price over a year and a half. And since then, over the last year and a half or so, the Bloomberg Commodity Index has been dead sideways, a couple percent either side of 100, which, by the way, historically is very cheap. You go back and look at 2008 high, it was 230 something. And the 2011 high, it was like 170 something. And right now we're trading at 100 and people say commodity prices are through the roof. They haven't even begun. So as an asset category, it's still cheap. We argue that the sideways price action for the last year and a half is basing action. And when we run our quarterly momentum, like we do with the stock market, which indicates downside breakage, we run it on commodities like the grains or oil. Natural gas is already broken out, for example. And the Bloomberg, we see that like 1% or 2% above where you are right now, you're going to break these markets out to the upside again. So I don't give a D whether the Fed says they're concerned about inflation. If those commodities turn, they'll have an integrity of their own. First, because they're still dirt cheap, historically speaking, compared to past peaks. And once asset categories break, money flows into other asset categories. Well, there's a lot of stocks related to commodities, which will benefit greatly from a commodity upturn, particularly ag-related stocks. And so I think you're going to have, that's another place to be in 2025, is commodity-related stocks, which do not correlate well to the direction of the U.S. stock market, by the way. So don't be fearful of that issue. And commodities in general will reassert themselves, which will, of course, lead into that quarterly break I told you about. Gold has the opposite situation pending, where it goes up again. And this time, we bet that if the stock market starts to break our trigger numbers, especially as we get into next year.
MichaelOliver's insights highlight a critical shift across multiple asset classes. Gold, poised for another historic bull run, could surge to unprecedented levels as the stock market bubble bursts and central banks resort to monetary excess. Gold miners remain in a broader uptrend despite pullbacks, while commodities, currently in a basing phase, are set to break out and attract significant money flows. Meanwhile, Treasury bonds could rally as rates drop when investors flee a weakening stock market. These dynamics suggest a substantial market realignment, with gold and commodities emerging as key beneficiaries. What indicators should investors watch for to confirm the anticipated breakout in gold and commodities? How might central bank policies evolve if a stock market bubble bursts, and how would this impact gold's momentum? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.